On today's episode, we will be discussing the stock market. As always, I'm Braden, he's Jordan. Together, we are the Realist Idealists, and this is Powerview. Okay, so slight change of plans. Jordan, unfortunately, during the recording, had some technical issues, which resulted in us losing the first half of his recording. So, because of this, I'm going to re record the first half of our conversation by myself. We will eventually cut to the portion of our conversation that we do have, so hopefully this won't feel too disjointed as I take you through the beginning of our overview of the stock market. So, on to today's topic, the stock market. I'm sure it's fair to say that most people in general are at least somewhat familiar with the stock market. In fact, I would even assume that if you're listening to this, that you're probably already invested in the stock market. Regardless of whether or not you are invested within the stock market, you probably are aware that the stock market is a way for the public, meaning you and I, to have the ability to invest in businesses with the hope of return on your investment. If that's where you are in your understanding of the stock market, you really should be asking yourself if this is really all you should know about the stock market. And of course, the answer to that is definitely not. So here's a bit of a crash course. If you truly want to understand the stock market, like so many other things, you really need to look at its history. So our story begins, ironically, not with the first stock market, but rather what inspired the first stock market. And that, of course, is the Dutch East India Trading Company. Now, this was technically unintentional on their part, but indirectly or directly, I guess depending on how you want to look at it, they became the world's first publicly invested company. And publicly is the key word here, as prior to this, you basically had to be a pretty big player financially if you wanted to invest in a business or expedition. Typically, this was limited to people like kings and other nobles, as well as a few wealthy business elites that existed in society. This is because usually it would be one or two people funding the entire enterprise. The Dutch East India Trading Company, on the other hand, was the first to realize that you could actually raise more capital if you opened up to smaller investors rather than just one or two large investors. As long as people assumed they would get a return on their investment for the expeditions that they were financing, the larger the expeditions the Dutch East India Trading Company could make, which furthered their overall chances of success. This is going to be an important thing to remember as we continue this conversation. So, fast forward to today, and we have stock markets all around the world made up of companies seeking investors. These companies, just like the Dutch East India Trading Company before them, are seeking as many investors as possible, but instead of going to people directly, they do this by publicly listing their companies on their local stock exchange. With a predetermined amount of shares representing the ownership of the company. Since there are a limited number of shares in a company, the value of each share is determined not simply from the balance sheet of the company, but also the demand or rather interest in investing in that business. And like any good market, the public bids on how much they are willing to spend to get a stake in that company. That, of course, leads to how do you value a share of a company? And the reality is, there are many ways to evaluate a business. And for the purpose of this episode, I have no desire to explain them all. But what I can tell you is a few basic terms that you ought to know when it comes to evaluating a stock. The first is earnings. Earnings is the company's net income, meaning the profit after they have paid off all their expenses. The next is shares outstanding, which is the current shares held by investors. Earnings per share, on the other hand, takes the total earnings and divides it over the number of shares outstanding to be able to show what value of earnings each share has earned. Next, we have PE ratio, or price to earnings ratio. This is essentially how much people are having to pay to gain access to the earnings per share. It makes more sense when you look at the formula for calculating it, which is the share price divided by the earnings per share. Basically, how many times earnings do people have to pay to own the stock today? And finally, we have market cap, which is the total value of shares in a company based off of the current share price. All right, now that you know all that, it's time to get an understanding for the different types of investments found on the stock exchange. The first and probably most obvious, of course, is stocks. Stocks are the shares of a company, aka the portion of a company that you're able to purchase on the stock exchange. Okay, so that leads us into where the recording I do have with Jordan and I discussing the stock market in further details. I know I went through the first half of this conversation pretty quickly, but hopefully you were still able to get an understanding of things. So, without further ado, let's get into the second half of today's episode. Okay, so some slight technical difficulties. Hopefully, I can edit this all together properly. But we got cameras working again, got audio working, so we'll get back into it. So what's that, Jordan?
All good to go.
Yeah, all good to go. So I believe if we've done this correctly, I had just talked about stocks as a type of investment, and then we were moving on to bonds. So bonds, again, typically a lot of people think of government bonds. That's where like kind of government treasuries and all that kind of stuff, where you invest in the government, so to speak, and then they will give you a return on that investment based off of how many years you're kind of committing to, right? Like a 10-year bond versus a 2-year bond, right?
Yeah.
So you get a percentage. That's the nice thing about bonds in particular compared to stocks is there's technically a guaranteed return on investment, right? Like they've determined, okay, for if you want to invest your money for 2 years in this bond, it's going to give you a return of this, right? The same thing also exists, though, for companies that are trying to raise some capital, that they will offer bonds. Like, so you mentioned Loblaws. I don't know if Loblaws has ever done this, but the equivalent of Loblaws offering a corporate bond. Sorry, I was going to say commercial bond, but a corporate bond where, again, like I said, you can put your money in to invest into them, and then regardless of how the company does, they're guaranteeing a return on investment of blank, right?
Yeah.
So definitely has some benefits. It can be a lot more of a conservative, like less risk associated with going with bonds, but also, as we've seen in recent years and months and all that kind of stuff, that bonds also fluctuate quite a bit, right? Because you can lose out on some money because if, let's say, it's a government bond and interest rates are low, but then all of a sudden interest rates jump up, which we know just happened, or like relatively speaking. If I had locked in at that lower percentage, well, now I'm going to lose out on that potential return. In terms of the interest rate changing on those bonds, right?
Yeah.
So gives you, and again, so we got stocks, we got bonds, and then commodities. Commodities we've talked about in the past, but commodities are all of the like publicly traded resources that are like traded globally, right? So oil is a commodity, silver is a commodity, right?
Gold.
Copper, whatever. Yeah. Right? All of those things. All of those things you can what's it called? Exchange on the stock market. The only other one that I guess sometimes gets lumped in, but it's not really a part of the stock market, it's a different market altogether, would be the like Forex market, which is for trading currencies, right?
Oh, okay.
But we're not going to focus there, though. Though they have their own whole deal and stuff going on with that, and money to be made or exploited or whatever you want to call it. But nevertheless, for today's episode, for simplicity, we're going to kind of stick within the just general stock market.
Basic framework.
Yeah. And to be honest with you, I'm not even going to really focus a whole lot on like bonds and commodities. I really am going to focus on just like general stocks. You can insert the same frameworks of things that we're talking about over top of those things as we get on with this episode, but nevertheless, that gives you a bit of an idea of things. So, you have stocks, you have your bonds, you have commodities, you have all these different things. There's different ways that you can purchase these different types of investments, right? Of course, there's individual stocks, right? Where it's just, again, I'm going to buy a share of company X here.
Kellogg's.
Yeah, right? Insert name.
Generic brand, yeah.
Yeah. Then there is something that I think a lot of us, especially if you have invested in the stock market before, are familiar with. It's mutual funds. So a mutual fund, as the name kind of, I guess, self-explanatory, it's that we are pooling our money together to mutually benefit from the profits. So it's, again, that whole idea of purchasing power. Right. Yeah. So I might only have, I don't know, $100 to invest in the stock market, let's say. Right. But if I was going to take that $100, I probably can only buy a small handful of stocks. Maybe I'd be lucky because I'm buying some stocks that are pretty cheap, like in terms of not necessarily their valuation, but cheap in the sense of like for one stock, it's only $10, let's say. Right. Whereas there are other stocks that like to buy one share is $700, right? Or well above that.
Like I think Tesla was one of those ones where like it's gone up a lot in the last 10 years, right?
Yeah, or I mean, you can go real crazy in things like Berkshire Hathaway.
Okay.
I apologize if there's a lot of clicking because I'm typing here. What's this going for? Silence, the worst thing to do. Okay. So currently, if you want to buy their Class A shares, which is like their like main ones, even though the vast majority of us will never buy a Class A share of Berkshire Hathaway, and not to go down this rabbit hole, but this is Warren Buffett's like company, I guess company is the easy enough way to phrase it. But to buy one share in Berkshire Hathaway's Class A shares is $628,930. So if you wanted one share, you're paying over $500,000 just to be able to get a piece of that pie.
That's just for the single stock. So
yeah. Now they do have Class B shares, which are a lot cheaper, but again, we're still talking a good chunk of change. So yeah, nevertheless, as I go on that tangent, we have individual stocks that you can purchase. We have mutual funds that you can purchase. So it allows you to go to a bank often, or I guess certain investment management portfolios where they are going to take your money along with my money and a bunch of other people's money and buy some stocks in different investments.
Group it all together,
Yeah. So that's what a mutual fund is. The kind of bad rap, if you want to call it that, around mutual funds is there's obviously a fee that's associated with that because it's not you investing, it's someone investing for you, right? So let's say I'm the manager of that mutual fund. I'm the one deciding what stocks we're buying, when we're selling, all that kind of good stuff. So you as the investor are going to make the profits, but you're going to pay me a fee of whatever, let's say it's 2%, right? Of the total value of the fund, right? And that's the other thing with a mutual fund is that you're getting the manager of that fund is getting paid regardless of how the fund does, right?
Yeah.
So we could all be losing money, but the fund is worth X amount, and I still am going to take my 2%. So that's another way to purchase. And then the other thing that I wanted to kind of touch upon that's very similar to mutual funds, but a lot different in somewhat capacities, is an ETF. So an exchange traded funds.
Fund. Yeah, that's
Right?
it. Thank you. Yeah.
You don't really ever have to remember that those three words, but ETF, if you just know that, that's basically taking ETFs and / index funds are kind of like interchangeable somewhat.
Changeable. Okay. Yeah.
An ETF is more of like, I would say, a broader term for it, in the sense that an index, for instance, is specifically focused on a certain grouping of an industry, right? So you could have the like bank stocks within Canada. So you could have an index of that, but essentially it's like, okay, I have an ETF of all the bank stocks in Canada. So whatever, go down the list of all the banks that you can think of.
Yeah. Big
This
five.
fund,
Whatever.
when I buy one share of this fund, it allows me to invest a little bit into each one of those companies, or in each one of those banks in that scenario, right? And so you can have an ETF around just about anything, really.
Yeah.
But obviously, some of the larger ones are going to be some of the index, like the S&P 500, which is the top 500 companies in the United States, or the TSX 60, which is the top 60 companies in Canada, or so on and so forth, right? But you can also have, certain industries. Maybe you have an ETF that's focused around green technologies. I don't know, right? And so you can have everything from like a tech oriented ETF. So you can have Facebook along with Nvidia along with Microsoft all in like one
Yeah.
fund, even though they kind of dabble in different areas, right? Nevertheless, ETFs, the kind of interesting or nice thing about them is that they again, you're pooling a lot of money together, similar to those mutual funds. But
Yeah.
because they aren't actively managed in the way that a mutual fund is,
Yeah.
because they're just kind of tracking a market. So we talked about the S&P 500, the top 500 companies in the United States. If you have an ETF that is trying to track that, it doesn't require any thought process on when to buy and sell things. It is simply following what everyone else is doing, like to the S&P 500. So, I recently Nvidia has really jumped up, right? They're like the number, I don't know, like 2 or 3 company now, like on the S&P 500. So they've skyrocketed up there. Well, okay. So if I'm a manager of that ETF, I would have to make sure that we're buying more shares of Nvidia to balance out the portfolio to mimic what the S&P 500 looks like, right? Now, you might also not buy more shares. Maybe you're just going to sell more shares of something else so that the percentages all add up. Again, not really that important, but the bigger part about it is like you need to know that, yes, with an ETF, they have to adjust things to mimic the actual market, which obviously is going to affect the price of different things. And similar to those mutual funds, you're combining a lot of funds together under one manager to go purchase these different investments, right?
Investment, yeah.
The only other it's funny, I was going to say the only other option that you can do for purchasing stocks is options. Yeah, so for again,
that was forgot about that. Yeah, thank you.
yeah, yeah, right. It's not necessarily the most common thing, right? Most of us who invest don't invest in options. It's a little bit more complex. It requires a lot more capital up front. The way that options work is that you're basically, ironically, because Jordan, you were talking about how like investing is a bit of a gamble within the stock market. In the case of options, you're essentially putting a bet on a certain stock or on a certain index or whatever you're looking at. Um, you're putting a bet that it's either going to go up in price, or you're putting a bet that it's going to go down in
Stumble.
price.
Yeah.
Yeah. Um, Options have a little bit of variations with it. You have to have, like, each option contract is what they're called, requires 100 shares of whatever we're talking about here. So
Yeah.
whether it's 100 shares of an ETF or 100 shares of an individual stock, it doesn't really matter.
Yeah.
And then you're basically also deciding. So we have the kind of two scenarios of, like, it's going to go up or it's going to go down.
Go down.
But then we're also having the situation of, you can be someone who is putting your actual shares up for an options contract, aka I own 100 shares of blank company, and I'm allowing them to be utilized for an options contract by someone else, right?
Yeah.
Maybe they're going to, yeah, whatever. Again, I don't want to go heavy into, like, explaining options, but you have essentially, yeah, someone who's putting up those stocks versus someone who's going to borrow those stocks and say, okay, I believe that these stocks are going to go either up or down, and I'm going to, like, hold on to them and pay you a fee.
Yeah.
Right? And so there's a lot of ways to make money with options, both in the sense that if you are, like, putting your stocks up for options, for instance, you can make a fee for that.
Okay.
Like, so it's not that someone is automatically buying all of those shares from you. It's that they have the options to buy those shares.
Yeah, and then you set the fee. Yeah.
And then you get a fee regardless, right? Like, automatically. So that's one way to make money. The other kind of more interesting thing about options is that, and I think I had kind of talked to you about this prior to even just doing this episode, is that with options, it kind of, you can make an argument that it could potentially limit your upside. But I would argue it limits your upside slightly. The more important thing is also it can limit your downside, right? So
Okay.
if I'm assuming a stock is going to go up in price, right? I might buy an option to buy a stock at a certain price in the next, I don't know, year, let's say. And as long as that stock goes up above what my option contract said,
Yeah.
right, I can make money off of that. The nice thing is that if it doesn't, let's say this stock either doesn't go up that high or goes down quite a bit, right? Like, I don't know, something happens in to that company or in the market. I don't have to buy those stocks.
Yeah.
Right. So sure, I paid a fee to potentially have the option to buy those stocks, but if I don't want to buy it, then I've minimized my losses. That, sure, I lost that fee, but maybe I didn't lose the equivalent of 10% on 100 shares of blank stock, right? Like,
Yeah.
company. So yeah, a little bit confusing, right? Because again, I apologize to anyone who isn't as familiar with the stock market and stuff like that, because I'm not totally explaining everything on purpose. If you really wanted to go learn about all those things, I suggest do it. It's really great. It's good to know those things. But for the purposes of our episode, I hope people get an idea of just, like, yeah, how you can buy stocks or investments, the types of different investments that exist, that general aspect of things, right?
Yeah.
I think that gives you, or I'm hoping that it's going to give you enough to just have a bit of a base of, okay, this is what the stock market is, right? These are how companies choose to list themselves. This is how businesses can be valued.
And how people participate in it.
Yeah, how they participate in it. Thank you, right? All those kind of good things, right? So on the surface, again, like everything, there's maybe a little bit of difficulty in the sense of like supply and demand can make things a little bit like unclear of how to evaluate things. But for the most part, I think on the surface, it does look like the stock market is pretty fair, right? A lot of people,
On the surface, yeah.
yeah, the reason why a lot of people invest in the stock market is not simply just because it's you're not having to shell out the same amount as buying a house or building a business from scratch or whatever, right?
Yeah.
You may not be dropping that much capital into it, but you're doing it also in the thought and the hope, I guess, that it's a pretty fair system.
Yeah.
Spoiler alert to anyone who kind of feels that way. The stock market does have a number of ways to why it can be exploited, right?
Yeah.
And so I think go actually no. You know what? Maybe for argument's sake, we'll save that because I know that there was a lot of stuff that we talked about in this episode. A lot for people to digest. I don't know, Jordan, without us going into the exploitation, because maybe we'll save that for an episode 2. What do you have any like questions about just like the general aspects of the stock market, how something can be valued, anything like that?
Me, like personally, no, but like it's one of those things
Oh,
where it's
even on behalf of a
yeah,
listener,
but
yeah.
it's one of those things where it's like I'm just trying to think of the right way to word this here. It's a way for you to participate, like I'm trying to think, like individually within the economic structure outside of like your normal like trade, if that makes sense.
Yeah. So
Like,
kind of I think going back to that original point of with the Dutch East India Company, right? That
yes,
this was the first time that general everyday public could make a few extra bucks in investing
buy
in
into
something.
big
Yeah.
big ventures in that sense, right?
Yeah,
Like,
multi-million dollar ventures and companies and all that stuff that you can have a piece of some of the most like biggest companies in the world, which before that would be like a closed door uh what's it called, like
yeah,
business
meeting,
deal. Yeah,
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 that you wouldn't be invited to.
backroom deals kind of thing,
Yeah,
which
right.
obviously still happen, but yeah,
Yeah, but in the case of publicly traded companies, right? um like if I wanted to, I don't know, like Microsoft or Facebook or Apple, like these are billion-dollar companies, I can have a piece of that company, and I technically am not limited in the amount that I could potentially
yeah,
buy into it, right? Like if I'm really invested and I want to be like a minor shareholder or even a major shareholder within a company, if you had the money, you could do it, right? Like you could, it might be over time, but yeah, you could definitely get to the point where you do have a real stake within the economy and within different businesses.
yeah,
That you definitely weren't able to do prior to something like the stock market, right?
yeah. Especially if you go back to that scenario, yeah,
Yeah. Um, the only actually, I guess the other thing that I didn't really talk about in this episode, at least, is that there are also aspects of the stock market where you can choose to buy things on essentially like a line of credit.
yeah,
That like when you like kind of use leverage essentially to buy stocks, so that's another kind of interesting aspect of the stock market. So similar to how we talked about with the housing market, I'm gonna go buy a house. I'm not going to buy the whole thing in my own money in cash. I'm going to get a mortgage and I'm able to
yeah. Pay
purchase
for it
it.
in
Yeah.
pieces, yes.
Yeah. So even though I own my house, I technically only own whatever, 20% of my house, right?
Correct, yeah,
But like obviously you have to pay that credit line of credit back. But in the case of the stock market, we have something called like margin like accounts, which allows you to get those line of credits. You may also have a situation where if things are looking a little bit too over leveraged, or that a certain investment that you're invested in using that leverage isn't doing so well, you might have something called a margin call that happens. And that's where it actually, if anyone's seen that movie, there's literally a movie that's called Margin Call.
Margin call.
Yeah. Essentially, if the institution who's lending that money feels that the bet, so to speak, is too risky, they might call a margin call on your account, in which case that they're asking you to pay back some, if not all, of the line of credit that they've kind of given you, right?
Yeah.
And that obviously is going to change some things up in terms of how you get to invest in the market, what's going to determine the value of things. But yeah, I think for argument's sake, we'll pause it there. So it's a little bit short, short and sweet. We're trying to do better with that, or I'm trying to do better with that. So I'm not overloading people with information, but yeah, why don't we call it there? I think that gives people an overview of just, okay, this is how the stock market works, how you participate, all that
Yeah,
good
this
stuff.
is how you get into it. This is how you play with it, kind of thing.
Yeah, yeah. And then our next episode, we can touch upon, all right, so we know how the system works. Is it as legit as it's trying to make itself out to be? Right? So I think on that note, I'm Braden. He's Jordan. Together we are the Realist Idealists, and this is Powerview.